Hey everybody, it's Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage, and welcome back to 1 Minute Monday. Each week, I'm going to break down what's happening in real estate, mortgage rates, and the economy, just how you consume it best. So if you're somebody who really just doesn't care how the clock's built, but you just want to know what time it is, the next minute or so, it is probably for you. Now, if you like to know how the clock works, stick around just a little bit longer for some additional details. And for my friends who really like to know how the clock's built, we're going to go deeper towards the end, building on prior week's updates. All right, let's go ahead and start with the short version. So mortgage rates, they're holding relatively steady this week, according to Mortgage News Daily. The national average 30-year fixed rate, it's right at 6.19%, with the 15-year conventional about 5.76. Now, on the government side, the 30-year FHA, it's about 5.85%, and the 30-year VA, it's around 5.87%. Now, everybody, these are national averages. They're not guarantees. Your rate may be lower or higher based on a handful of criteria, like your residential mortgage credit score, the amount of equity you've got in your home, your loan type and debt ratio, and, of course, the color of your firstborn child's eye. Is just kind of kidding there. Well, moving on, inflation data came in largely as expected. The Fed's preferred inflation gauge is core PCE, and it's running around 2.8% year over year, and that's still above the Fed's 2% target, but recent monthly readings have cooled compared to earlier in the cycle. Now, housing activity has slowed, with pending home sales down about 9% from November to December. And this data is always tricky around the holidays and winter weather, especially when inventory remains a little bit tight. Now, one important piece of news that literally flew under the radar but actually matters for mortgage rates, the FHFA actually raised the amount of mortgage-backed securities that Fannie Mae and Freddie Mac are allowed to hold, and that was following direction from the administration to increase mortgage-backed security purchases. Now, more demand for mortgage bonds generally helps keep upward pressure on rates in check. Now, that's the quick snapshot. If you were just looking for what time it is, your work here is done. Now, let's go ahead and slow it down and talk about how the clock actually works. But hey, before I go there, I hope I can count on you to like and subscribe. It lets you know when new videos are released, and it helps me continue to produce this content for you. And if there's something that you'd like to learn about but I've not mentioned so far, just shoot me a message in the comments or a text, and I'll get to work. So when it comes to inflation, core PCE is the number that the Fed cares about most because it strips out food and energy volatility. And while inflation is no longer surging, it also hasn't cooled enough to give the Fed a clean runway for any kind of aggressive rate cuts. Now, Fed Chair Jerome Powell, he's been clear for months now that there's no risk-free path forward, and they're trying to balance inflation that's still pretty darn sticky with labor data that's kind of quietly softening. Now, the labor data, it's pretty interesting. Initial jobless claims, they remain historically low, which it tells us layoffs are still limited. But continuing claims suggest that people who lose their jobs, they're taking a whole lot longer to find new ones. And that combination, low layoffs and slow rehiring, well, it's really consistent with a cooling, not collapsing economy. Now, let's go ahead and talk about housing. The drop in pending home sales, it sounds really dramatic until you add some context. Inventory remains extremely limited. We've got roughly 1.18 million homes nationwide, and that actually matches some of the lowest levels that we saw last year. Now, closings actually improved in December, but fewer new listings actually meant fewer options. Now, fewer options almost always means fewer contracts signed, and even when buyer demand exists, those fewer contracts, again, they just don't have a whole lot of options. So at the same time, the broader economy, it still isn't rolling over. Final third quarter GDP, it actually came in at a really strong 4.4% as an annualized pace, and that's the fastest growth since 2023. Now, consumer spending, it was a major driver, and that was helped by really strong vehicle purchases and solid export activity. Durable good orders, they also surprised to the upside, reinforcing the idea that there's parts of the economy that are still moving a lot faster than a whole lot of people expected. And from a market perspective, mortgage bonds, well, they're holding above those key moving averages. And the 10-year Treasury, it did slip back below its 200-day moving average. Now, look, everybody, that doesn't guarantee lower mortgage rates, but it does suggest that the bond market actually has some breathing room instead of being under constant pressure. Now for my clock builders. This is where strategy matters. What we're really dealing with right now is an economy it's just too strong to force rate cuts, but soft enough to keep the Fed pretty cautious. And that combination, it usually leads to range-bound mortgage rates, not collapsing, not spiking, just kind of moving within a band based on the incoming data. And that's why trying to time the perfect rate tends to kind of backfire a little bit. The better approach is planning around ranges, not predictions. And this also builds directly on what we've been talking about the last few weeks, leading versus lagging indicators. Now, pending home sales, they're a leading signal. When contracts slow today, closings tend to slow 30 or 60 days later. And that can quietly restore negotiating leverages for your buyers in certain markets. Not everywhere, not overnight, but enough to matter if you're actually prepared for it. And another concept worth reinforcing here is leverage. Housing is a leveraged asset in a way that many people kind of overlook. A modest change in home values can translate into a much larger return on the actual cash invested through a down payment. Now, that doesn't mean that retirement accounts aren't critical. They absolutely are, but it explains why housing continues to play a central role in long-term wealth building, even in higher rate environments. So looking ahead, this week's all about the Federal Reserve's policy decision and press conference, along with some home price data from Case-Shiller and the FHFA. Now, we'll also be watching jobless claims and the Producer Price Index, or PPI, for clues on labor and inflation trends. And those are the inputs that really truly shape rate movement. Not headlines, not social media takes, just data. Now, the takeaway is this. Whether you're buying, refinancing, or advising your clients, this is a market that rewards preparation and patience, not guessing. The goal isn't to predict the perfect moment, it's to make smart decisions with the information that we have today and a plan that fits your risk tolerance. Now, if you ever want help actually walking through what this means for your specific situation, that's exactly what my team and I do. And if these updates help you, please feel free to share them with somebody who just wants a clearer picture of what's actually going on. I'm Doug Shoemaker, and I'll see you next week.